Hi and welcome to Carnegie and our interview with Bergman and Beving. I got with me Magnus Söderlind, who's CEO at the company. Hi Magnus.
Hi Markus.
So you released Q4 earnings,
Yes.
split financial year this morning. If we start talking about the markets, so minus 12% organic growth. And you said part of this is market and part is the focus on profitability that you've had. You've had the phasing out of products for some time. And we come back to that, but if we start with the markets, what are the markets like? And have they gotten incrementally worse?
Mm. I mean, as communicated in the autumn last year, we faced a weaker industrial demand generally. And that kind of level has continued in this previous quarter. The construction sector, I mean, has been a little bit weaker during the full fiscal year last year, and that has also been stable on this kind of little bit lower level this quarter as well.
But you would say that if I compare like calendar Q4 to calendar Q1,
yes,
it's kind of been at the same level.
Yes.
We're not seeing a deterioration, but it's kind of bottomed out, so to speak.
Hopefully.
So from what you can see now, it shouldn't get worse, but we should kind of like, from what you can say now.
Yeah, it's a guess game,
Yeah.
but my expectation is that they shouldn't get worse. But I don't see that it will pick up until autumn earliest.
Yeah.
That's my expectation.
And this goes for both industrial and construction.
Yes, I mean, if you look now, you see some strengthening in the residential building area in the Nordics. But our companies is not so exposed to that segment, so we haven't faced that kind of rapid decrease in market. But we will not see if there will be an increase, have any major effect on our companies as well.
And this phasing out of unprofitable products, which is strategic and which has been going on for some time now, and I think we talked about last time, we're getting to the end of it. Is the majority of the 12%, is it market now?
Yes, it is.
And I think you said in the call if you would guess a third versus two-thirds, so two-thirds is market.
Yes, and one-third is still that we change our product mix. I mean, we now have a 4% gross margin improvement this quarter compared with previous year. So we're now at 38% in gross margin. So that's, I think, is a great improvement we've done along the year, and we have said that you shouldn't expect that to prolong in the same kind of improvement speed going forward, since we now have the effect of this phase out of low margin, high volume products.
And if you look at the, because you also do the shift towards proprietary products where you have a high gross margin, and most of the companies that you buy also have high gross margins.
Yes.
Are they kind of in the same level-ish, around, let's call it 50%? Is that kind of the level, or is it possible to get higher than that even?
You mean the gross margin as
Yeah,
such?
the gross margin.
Yeah, I expect, as said before, we haven't leveled out at the 38%, but the improvement path will be a little bit slower going forward, and part of that improvement path is future acquisition that will help us to increase the gross margin even further.
And I think we talked kind of this summer-ish, the kind of strategic phasing out, and then of course it's a continuous work, but that's kind of when you will be ready, so to speak.
That's our estimate.
And if we move on, talk a little bit about acquisitions, because you were quite active last year. You were talking about adding some 50 to 80 million in EBITDA per year, per annum. Should I read anything into kind of a slowdown, or that you didn't do any acquisitions in this quarter?
I mean, we made 6 acquisitions last fiscal year. We made 2 each quarter, Q1 to Q3, and we didn't make any acquisition in Q4. However, we made 1 acquisition already this quarter in April 1. So the reason we didn't acquire anything in Q4, you shouldn't read anything to that. It was, we had some discussions, we had some cases, but by different reasons we didn't get all the way in those cases. So I think that the pipeline we have is good, strong. the kind of valuation expectation we are willing to buy on is there currently. So I feel confident that we should be able to deliver on the 50 to 80 million profit in acquisition per year.
And if we stay a little bit on the acquisition market, would you say that it's changed any? Not your situation, because it seems like it's a complete natural thing that you have, you know, ups and downs in terms of number of acquisitions made. What is the market like? Has it changed any? Or
I mean, if you take a kind of 2-year perspective, it has, absolutely. I mean, 2 years ago we didn't acquire any companies in the Scandinavian region because there were too many buyers, you know, willing to pay too high multiples. So then we acquired companies in the UK, we acquired companies in Finland. But if you look at the acquisition made last year, 5 out of 6 were in Scandinavia, 1 was in the UK, because many of those newcomer that was very aggressive acquiring companies at high levels is not in the market any longer. So I would say the competition is less now than it used to be 2 years ago when the interest rate was very low and many more players were there, you know, making acquisition.
And with the kind of progression of the interest rates, we saw the first cut in the Swedish interest rate just this week. And I mean, the market expects a couple of more decreases this year, but it's still going to be kind of a slow change. It wouldn't change the market much as you see it.
I don't expect many of those who were active 2 years ago still have, you know, need to work down their debt, and it will not most likely be in the market for some quarters to come.
And if you look at the number of conversations that you're having, they're kind of unchanged as well.
Yes.
Kind of, yeah.
Yes.
And if we move on to the margin, we mentioned the gross margin improvement, which is impressive. What are the main drivers of that? If we talk about internal versus M&A, because you do a lot in terms of your cost base, but you also come in companies with higher margins.
The majority of the gross margin we are having now is organically driven. It's a little bit spiced by the acquisition, but I would say absolutely majority of those 4% improvement is due to organic improvements.
And is it general, or is the majority this phasing out of low margin products which is driving the margin, or is it more a general cost savings?
No, it's generally about this phase out of no margin business. We have our capital allocation model that we use now across the group. We call it the focus model internally. And that is really, you know, emphasizing that the company should focus on the areas and the segments and the customer areas where you get, you know, healthy returns over time. So that has implied that companies have kind of closed down some types of operations who had decreased, you know, the product range to get more focused on the areas and the product range there they get better margins. So it's a combination of a lot of things that we have been doing organically to get this improvement.
And it's interesting to look at. I mean, look at the margins going forward. You don't give any guidance. You have a target, but if you look at your number of employees, is basically unchanged, both from last year Q4, but also from the end of last year. So it's kind of been, and revenues as a whole has also been largely unchanged.
Yes.
If you would just play with the thought that the market would actually take off, let's say in the second half of this financial year, do you have enough of employees, so to speak, so that we would actually see a pretty good leverage once this comes?
I mean, the kind of cost reductions we have done, it's close to 10% organically. We have been reducing cost. That is main efficiency measurements we're taking. We have used kind of the opportunity to kind of get the organizations more effective. And that is not cost we need to build on when the volume picks up. So I expect, as we have said in the report, that we are now have a very good solid base to build from when the market picks up again. And that of course will then have effect on the margins as such.
And if we look at your profitability target, the EBITDA or operating profit over working capital, 5% improvement or 5 percentage points improvement, which is quite impressive. But we still have a long way to go. So I think from 21 to 26, you went in this quarter, and you have a target of 45.
Yeah.
How do you think about this, and how do you expect to get there?
I mean, part of the reason that we still have a too low level is the corona that we have gone through, because we build up a lot of extra stock, safety stock, to be able to deliver to the customer due to the long delivery time from suppliers. So we are still not back to the kind of pre-corona level in terms of inventory turnover, but we are steadily getting there. And that will also have an effect, a positive effect this year. And this in combination with the improved profit margin. We have improved the profit margin with 1% roughly, 1.2 the previous year. I expect to continue to have that improvement path also on the profit margin. In that in combination will over time get us to the 45%. And that is 3 years from now we have set that target.
And is it mostly the inventory? If I look at the capital base and we leave the margins aside, is it mainly the inventories we're talking about here that needs to come down? So
I think we should improve in many other working capital aspects as well, but the biggest potential is in the stock.
And is it mainly because you have a couple of suppliers or wholesalers left, like for instance Luna, you bring up Luna in the report as doing quite a lot in this quarter. Are those the keys?
Yeah, it is. We have some bigger companies in the group. We have 3 companies in the group. Luna is one of them that has a turnover roughly 1 billion SEK. So they represent 3/5 of the whole group. So of course they need to improve to get the whole group to the 45. But we see now some good improvements in all of those big 3 companies, and they are going in the right direction. So I think I'm positive.
And then finally, maybe you close the books now for this financial year, and you go into the next financial year, 2024-25. What's going to be your key focus in the fall and in the spring?
I mean, we will continue what we've always been doing, acquiring highly profitable companies within the valuation range we have set. So that's part of our DNA and our kind of business model as such. And then it's about really having strategy company by company. Some of the companies should focus on, getting the top line growth, because they have the profitability that kind of support that growth allocation-wise, and some companies need to work on the gross margin and the cost level. So it's really, company by company agenda. So we don't have one agenda fits all in our group. We have 30 company groups within our group, and based on our capital allocation model, they have some different themes, but it's really about where they are in terms of profitability that decides what team they should have.
But those plans are in place, right?
Yes.
So it's mostly about executing on the plans which are already in place.
Yes.
Magnus, thank you very much for coming here to talk to us, and thank you for watching.
Thank you.